I have an advertisement thing in here. Here's the next. Okay. When that
Well,
sort of
good morning.
stuff pops up just right here.
We're dealing with computers as always. What else is new? So welcome to session 4 of Smart Exit Strategic Planning. We've made a lot of progress. We've been working together over the last 4 weeks, and today we're going to work on steering financials and steering your business. Are there any questions, points that we want to go over beforehand, or we'll launch and go? I'm sure you all brought your notebooks. So, and if you didn't, then you can now access all your files. And if you go to your Gmail email from Monday, you'll find a link on how to reach those. So at this point, I'd like to introduce our first speaker, and it's Alan Backrack with Wealth Strategies. And Alan and I have been colleagues from the Institute of Management Consulting, and he's going to be speaking this morning about retirement plans and options and ways to build your personal and your business wealth.
Yeah, good morning.
Give me one.
Oh, I did. See, I had myself.
Welcome.
Yeah. So, I'll summarize this. The need for this is so important. And if you don't realize how many people need to save for retirement, walk into Walmart and there's that person there that's welcome to Walmart. I mean, the number of people in this country, it's probably about 65% of the population has almost no money in retirement. I have a whole little presentation I can do, a little short video that shows just how disastrous people are. So I'm going to bring together what Jeff and John and I all do in a different sort of way. What's your most, tell me what your biggest asset is. What's your most important asset?
Well,
Business.
I'm gonna say our home, but yeah, business is number one, because that's creating money.
Yeah. Is it your business, or is what you do in the business to make the business effective?
Pretty much what we do with it.
Yeah. So one of the things that when I ask this question, the thing I often get from people is their home, sometimes their business, sometimes once in a while their retirement. That usually doesn't happen later. Probably your biggest asset is your income earning potential. And one of the things you should do is ensure that. That's another little thing that we do, because it can all go down the drain quickly. So we'll do that. But I'm going to just give an overview here on retirement and business and how it all works together. Is there a pen?
Yes. Markers, right.
Cool. So kind of in order of traditional retirement plans, you have an IRA, a simple, a SEP, a 401k, and then you get into deferred comp, and cash balance plans. Complexity and expense. Hopefully you can't put into an IRA, because an IRA you can't put in unless you have about more 130,000 a year in income, or about 165, 170,000 married filed jointly. You can only put in 6,500 into an IRA or a Roth IRA. It doesn't matter how you break it up. And if you start putting in $6,000 a year from now, and you're already more than 25, you're going to fail. I mean, you're just $6,000 a year just is not going to contribute to that much. And you better start working on the welcome to Walmart phrase. So that won't quite do it, but they're cheap and they're simple and they're easy. The next phase is a simple one. If you have a small business and a few employees, this is very, very nice, because in a simple you can put in a little less or a little more than let's just say $18,000, $20,000, depending if you're 50 or more. These are exceedingly simple. You get a lot of payroll reps that go around selling 401ks because they aren't licensed to sell a simple. A simple to set up costs $10 per person per employee. And if you want to put in for yourself about 20 grand, and for your employees, it's either 2% of pay or 3% match, up to a 3% match. Most people end up going with the up to the 3% match. Exceedingly simple. $10 per person per employee. Next, for small businesses without a lot of employees, you can go into a SEP. A SEP you can put up to $53,000 a year into. The problem with the SEP is it's a straight percentage. And if you put in 25% of your income, you earn $200,000, and you put in $50,000 into your SEP, you also have to put in 25% of your employees' pay. And for a lot of business owners, that gets to be a little bit spendy very, very quickly. But all three of these are nothing as far as administrative costs. And that's a big thing to put up. Now they can be, if you go with someone that charges a management fee to look at it, but really it's just buying mutual funds. And there should be the charge for the account itself should be $50, or in this case, $10 per person per year. So it's very, very little. Next, you get into 401k. So how much does a 401k plan cost? Anyone want to take a guess? Well,
Thousands.
this is probably one of the biggest. Let me put it differently. If I walk into the local coffee shop and ask 4 people how much does their 401k cost, I guarantee you every one of them will say nothing. I just get it as a benefit. So when you walk into the bank and open a checking account, does that also cost nothing? Do they just give it to you? There are fees embedded in a 401k plan. And this is where it really gets, the administrative costs on a 401k plan can be anywhere from about $1,200 to $2,000, $3,000, $4,000 a year. And if you're not putting that much into it, it really doesn't make that much sense to if you're going to put $15,000 a year total contributions or $20,000 into a plan that you're spending administration fees of $1,500 a year, you're sunk before you even start. If 4, 5, 6, 7% is going just to administrative fee. Now, for instance, I had a company recently that all of a sudden they realized, woke up one day and they had almost 50 employees and they were using a SEP plan. And they were fine with that because they were just doing a straight 5 or 6% pay. Everyone went into a SEP, it didn't cost them anything. But then they wanted a little more diversity, and spending $1,200, $1,300 a year amongst 50 employees, it's nothing. They were perfectly happy with it. There's one big difference here. These are all deferrals. Not savings. They are deferrals. You will listen to the radio, and if there's anything that gets a good planner like me more upset, is to listen to the talking head on the radio talking about a retirement plan being a tax savings plan. They are not. They are not tax savings plans. I defy you to go to the authority, the federal government's website, they have all kinds of things, and you read any of these plans, you will not see any word about savings. It will talk about deferral, 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 deferral. You're deferring the money. You're going to be taxed on it. Now, if you put into the plan a decent amount of money, and you get there to retirement, and let's say you have $1 million or $2 million a year, and you do the traditional thing where you're taking 5% of $1 million or $2 million a year, then you're living off of $50,000 or $100,000 a year. Taxed. On top of that, you have Social Security, you have residuals from whoever's running your business, however you did it. You're not, what you just did is while you were growing your business and you had a house that you paid a mortgage on, maybe a dependent or two. You deferred it to when you almost had the house paid off and no longer have any dependents. Maybe your income went down a little, but your tax bracket went up because you don't have any more deductions. This is a deferral, not a tax savings plan. Unless, well, there is the Roth option here. This 5,500 or 6,500 if you're over 50 can be done as a Roth. The 401k can be done as a Roth contribution. Your limit on a 401k is $53,000. Wait a minute, I let the cat out of the bag. But you didn't hear me. What's the limit on putting money into a 401k? Do you have any ideas before I came in? What that is? You want to take a guess? So what I usually get is 18,000, 15,000, 20,000. The limit on putting money into a 401k plan is 53,000 or 59,000 if you're over 50. Of that, 18,000 or 24,000 if you're 50 or over can be on a Roth. Now a Roth is a very, very, very interesting vehicle in the savings world.
Is it an acronym for something, or just, what does it mean?
No. Senator Roth.
Oh, okay.
You caught me, you may think. I mean, simple is an acronym, it's like, which I can't remember. But the Roth was for Senator Roth.
Okay.
Roth means you put post-tax dollars in. Now, this is where I'm going to separate myself from every CPA. The job of a CPA, what's their number one job, is to file your tax. They have three jobs. To file your taxes correctly. Usually the second thing people want them to do is help reduce their taxes now. And the third thing is to keep you both out of jail. Right?
Good job, hon.
She's agreed.
Works for me.
And you don't like, those prisoners. So, we'll forget about the going around. That's not my job at all. I mean, I don't want you in jail either. My job is to look at the long-range perspective. And from a long-range perspective, having deferrals and more incomes, so you put money in a Roth, but the Roth is post-tax dollars. It's post-tax dollars. Now let's go back to that scenario. You have $1 million or $2 million in a retirement plan because you've been putting aside 40, 50,000 into the 401k, of which a big chunk of it was a Roth. If you can take the money out of the Roth tax-free, because now you have something left from that old business that you used to have when you were in your 50s, 60s, and maybe even into your 70s, but now you don't have it. Taking the money out tax-free is huge, and you can grab it. I always tell people, having a Roth option, you want for when the years are good or the years are bad. Oh, the stock market went down, my rental income went down, I had all this expense. I want to take the kids to Disneyland, I don't want to pay taxes on it. Good or bad, having a tax-free bucket. From my perspective, diversification isn't your large caps, your small caps, your international, that whole thing. That's the very, very, very last thing I do for a client. The first thing I do for a client is get up there and say, let's look at diversification. Business, some money in maybe insurance and annuities, some money in retirement, of which some is in Roth, maybe a rental property, maybe some residual income. That's diversification. So having the money into a Roth, so you can get a tax-free bucket, that is really good long-range planning. Now, if any of you get and to put a Roth option on a 401k, if you don't have a Roth option, all I have to do is hit a checkbox. That's it. There's no extra cost to it. So getting back to the cost part of a 401k, this is where it really gets a little tedious. It really should only cost under $1,500 a year to administer the thing. Unless you're in a solo K. A solo K is just the employee contribution if you're a one business, and then they're not quite as expensive. And you can put in about 24,000 if you're over 50 into a solo K, of which all can be on a Roth. So that's the administrative costs. Where you get killed on a 401K is the asset charge. I was looking at an asset charge from a payroll company a number of years ago, and where you have those target date funds, where as you get older, more and more goes into bonds, they're pretty much managed by a computer program. It's not very difficult. They were charging over 3% management fee. You don't see that. You don't see that. I had the same funds, we were charging a little over 1.5%. That's a 2% spread. If 2% doesn't mean much to you over the long run, what would happen if you went home today and you discovered your mortgage took a 2% increase? 2% is a lot over the long term. 2% can mean the difference in having your money double in 10 years at 7%. At 5% it would take 12 years. It's a huge difference. So that's it. Now I'm going to just quickly here, deferred comp and cash balance plans. Now this is where it all comes together, what John does, what Jeff does. Deferred comp plans can be an interesting vehicle. You want to sell your business, you're getting out of it. You could sometimes have, instead of having this nice young person who you love, you train, they want to do it, and they don't have 2 cents to rub together, but they have a cute puppy. I mean, that's about it, right? They're nice people. So how are they going to possibly buy the business? Well, you're going to stay on the business for a few years, and they're going to fund your deferred comp. It's all tax deferred, but it might be the only way you can actually pull it off, because you have to stay there to help fund the business. You're vested in it. If you don't stay, they can't fund it because you can't help them. It makes it a real win-win. What's the disadvantage of it?
They could, they could lose customers, they could not, the quality of business might go down.
You're thinking like a business owner. That's good. You want to help me, Sean? What's the disadvantage of it?
The big thing is that it's deferred.
Bingo. It's deferred. You're throwing it into income. If you sell the business, you might get capital gains treatment on it.
Right.
But if that's the only choice to make it work, it can work. Cash balance plans are very easy, are very interesting. That's another way, if you ever get to the point where the business just takes off and you've got, you're 60 years old, you've discovered you don't have anything saved for retirement, you're earning big money, and you want to start putting into the cash balance plan more than, mid $50,000. Cash balance plans, we can start to put in $100,000, $150,000 a year. And the advantage of a cash balance plan is we can, I won't say discriminate, but we can put way more for business owners and executives than we do for employees. If you start putting in $100,000, $150,000 for yourself into a cash balance plan, then you're putting 7% of your employee's salary in, which you just have to see the numbers. That's just a quick overview. I think I just used all my time. I love talking about this. I can talk all day long, which I better not do, or John will bite my head off. Your questions are welcome. Thank you very much. Anything quick?
Questions? What if you think that the tax rates will be lower when you retire? Do you think it's still a good idea to do a Roth? Than when you contribute, lower than when you contribute?
If you really think your tax rate's going to be lower when you retire,
Then you're on.
sure, go ahead and defer it. But when I actually do planning with people that are fairly successful, and I didn't say very successful, I said fairly successful. Because remember, if you start having $500,000 in retirement, and you start pulling $25,000 a year out of that, and you start getting Social Security of $25,000 a year, that's $50,000, and the children are gone, the grandchildren are cute, but they're not dependents. And you have a little bit of residual, I mean, you're just not sitting on the front porch knitting and reading books all day long. You're doing something productive. So now 25, another 25, you're up to $75,000. That mortgage you had that you refinanced in 2010, 2016, something like that, at around 4%, there's nothing left to deduct hardly on it. You might discover your tax bracket isn't that high. If you really believe it, sure, we'll defer it all, if you want to.
Would it be smart to kind of split it up then?
Yes.
Maybe, okay,
Yes.
maybe put half
Yes,
and
yes,
half, that way,
Now, a lot
just in
of,
case.
a lot of times what I'll do with people is they'll put their money in their 401k, I have a law firm where I'm doing with this, and I'm getting them to, over a period of a few years, ratchet up the portion that goes into the Roth. I mean, I have all my money, all my contribution going into a Roth. What the employer puts in, because you're playing both sides of the fence, you're employee and employer. Remember I said 24,000 or 18,000 if you're under 50? That's the Roth contribution. The other $35,000 is all deferral, what the employer puts in. Now when you own your own business, you're both. So, but the 35,000 has to be deferred. So the most you can do on that side is 24. But we'd like to have something in that bucket. Is that kind of accurate? Okay.
Alan, thank you very much.
My pleasure.
Thank you.
Thank you. And for my second act.
We have to think prosperous. We have to think prosperity. We have to think abundance. We have to create money for savings. When we say, well, you know, there's no extra money. Listen, if you're struggling on 100% of whatever you're getting, you're going to struggle on 95%. So what's the difference? Do an automated deduction from your checking account, from your business checking account. And I do the simple, and one half of it is a business contribution, and one half of it is an equity draw, a dividend, shows up as a dividend. So 50%, I do a split transaction in QuickBooks and split it between personal taxes and a business contribution. So that's something that we all can do, and you can do it with $50 a month. You can do it with, you know, $25. I mean, most houses now, and you just set it up with bill pay, it just goes automatically into your account every month, and it adds up over the course of a year. Next, we're going to talk about mindset. Before we go into mindset, we're going to very quickly review today's agenda, because it hasn't been on here. The key is to just start thinking and planning, and don't wait. The sooner you do it, the better, because of the power of compounding interest. So today's program, we just heard from Alan. Patrick is going to talk to us about the importance of mindset. I'm going to speak briefly on financial management, and Sean is going to talk about accurate financials. Today's program is financials and steering. Then I'm going to speak about steering your business. We're going to do all of the questions in one batch today, and we're going to remember to push the submit button at the end. And then we're going to tie it all together with questions and answers and look forward towards step number 5, session number 5. Mr. Locke, thank you very much, Patrick.
You're welcome. Thank you. Mindset. Mindset. What comes to you when that term mindset enters your brain?
I'm gonna say focusing on.
Focus, okay.
Positive thinking.
Positive thinking.
Aligning with how you'd like it to be,
Aligning with you how you'd like it to be.
aligning your energies and your Thank you.
exactly. Okay, those are good. Mindset is one of the most important elements to work on your business instead of in your business. Right? Operations can take up a lot of time. And operations can take up time when you need to do other things. The phone rings, an order has to get there. You have to get something taken care of. There's all types of things that happen during the course of that day that take you away from working on your business. This takes mindset. You have to purpose yourself to do those things that are going to create your business to grow, to move in the direction that you want it to create that place where it's going towards that vision that you have for your business. Now there's a few things that you're in business for, and we talked about this before. One, you want money when? Now. Two, you want money that you can put aside for emergencies and for other things that you want. And three, you want money later on when you decide you don't want to work any longer. And in order for those elements to happen, you have to get in the proper mindset to create that business in the form that's going to produce those elements. So how do you do that? What's necessary to bring yourself to the place where you're doing that in an unstressful manner? Because a lot of times we do it, but we put ourselves under a tremendous amount of stress, and that becomes non-productive. We have to purpose in ourselves and work with schedules, work with our employees, and work with developing the business in a place where it's going to continuously move in that direction. Think of mindset as how I perceive what I want. Keeping those things in mind of where you're going and not getting caught up in the everyday challenges of running that business. Because once we get consumed in that everyday challenge of running the business, we lose our vision of where we want to go. And it takes energy, it takes purpose, and most of all, it takes having that vision of where you really want to go with your business. Because when that vision is there, when that vision is a part of you, ingrained in you, you think about it, you work with it, you articulate it. When that becomes so much a part of you, then you will purpose in yourself then to do those things that are necessary for having that mindset. Is it easy? No. It's not an easy thing to do. If it was easy, everybody would be doing it, wouldn't they? And because so many small businesses fail every year, it's obvious that most people never do it. So it's important to understand what it is, to think about it, to recognize that I need to develop mindset. There's a lot of books out there that talk about all of these different elements in mindset. I've been reading one book, and actually, I would say more at doing that book than just reading the book. Because just reading something isn't necessarily going to do anything to change whatever habits you're looking at changing. It's taking that information and doing something with it that makes the difference. Visionary Leadership is a book that I've been working with for probably a couple of years. Understanding how vision, how developing vision, how to think about what is the vision that I have. And then how to inspire that vision, not only in myself, but in those people around me. The people that I work for, the people that I work with, to inspire them to move in that direction of the vision. Because as you create your business and as you develop your business, it's going to require that other people are involved in it. Because if they aren't, it's only you, and then you're going to be stuck doing everything. So inspiring people in the vision that you have for the business is important. So learning how to understand what your vision is. When you begin to do that and you begin to articulate your vision, to write it down, to understand what it means to you, you're going to be gaining that energy inside of you to do the things that you need to do. That is going to change your mindset. Does it take time? Yes. Is it arduous? Yes, it can be. Is it energizing? Most definitely energizing. I've found for myself, as I've developed my own vision of what I want for me, then it's gained energy. I've gained energy. I've clarified. I've written this down, and I've written it down again, and I've written it down again, and I've worked on it, and I've worked on it, and I've read it, and I've recorded it, and put it into my head. And now I'm starting to understand it better. And it's something that I may continue to work with. But you have to do this in your business to get the mindset that's going to put you above the normal. Because once you're above the normal, your chances of succeeding increase, don't they? And that's where you want to be, above the norm. And the normal person doesn't get that. So think about mindset. Think about